Thanks for tuning into Talking Point, and joining me today is a very important voice, Herald van der Linde. He's head of Asia Equity Strategy at HSBC, and his views on how they view India and how global investors might be viewing India and Asian markets at large would be very pertinent in the run-up to what is arguably the busiest election season for the world at large. Herald, good having you. Thanks for taking the time out. Would love to understand how have you thought of 2024? We talked to you at the start of the year, but have things or have views changed since the first couple of months have gone by?
To be honest, they haven't really changed that much, to be very frank. So at the beginning of the year, you're right, and thanks for having me on again. We spoke, and the view in India is that the outlook for India over the next couple of years is actually a pretty good one. There's pretty good growth coming through. Your GDP numbers are good, the earnings numbers are good, etc. The problem is the valuations and certain unevenness in the market. That's one risk. And the other risk is flow from money from India to China in case China starts to rally. Now, first on that unevenness, valuations are high, but what we see now is that the small caps start to underperform a little bit. The larger caps are picking up, and I think that's a very healthy development. I think that's where the value lies in this market. So do I think the market's going to rally a lot further? Probably it's going to gradually tick higher, and that's helped by global macro. But what I found encouraging as well is that when China started to rally over the last couple of weeks or so, the money didn't come out of India. It came from outside the region. So that means that people are separating, at least on this stage, China and India as different stories. And I think that might well continue. So I remain constructive on India, but it's probably not going to be a sharp rally up from here, but maybe gradually ticking higher.
Herald, I've had dichotomous views on the EM interest and the resultant impact on India, and would love to understand how you think about it. Because a class of investors and bankers who are telling me that Indian flows from FPIs would largely be dependent not just on India alone, but when EMs start looking attractive, and therefore, i.e., when China starts looking attractive. And at the same time, there's a separate class of investors who say that what will be China's loss will be India's gain. I would love for you to explain how you think about this.
Yeah. So in the past, we could clearly see that if China rallied, money was taken out of India. And if people didn't want to be in China, they went back to India. So that is where that first or the second argument of you come from. But if you look at positioning now, foreign investors positioning India is actually not overly aggressive. But they've gone to Japan and they've gone to Korea for a variety of reasons we don't really have to go into. But that's where they are hiding at the moment. My suspicion is that if China rallies, that money could come from Japan, from Korea, or from outside the region, and that they don't have to sell India. So I think India is not as much at risk of outflows as much as what we've seen over the last, say, 12, 18 months ago, or something like that. So that's a little bit different. The source of funding could be different now. So I would argue that maybe that first argument you made, that maybe it's a bit different, is going to be valid.
Okay. The other aspect is that after the JP Morgan bond inclusion announcement and maybe a possible Bloomberg announcement as well, Indian bonds might finally see idiosyncratic India-centric flows in a meaningful way. Do Indian equities ever reach that point wherein they are separated or they are not joined at the hip to EMs totally, and could see idiosyncratic flows coming in, or is that some time away?
No. I think in equities, at least I believe so, we will continue to be beholden at what happens in the global markets to a very large extent with equities, for the very simple reason, India is a big market, but you look at the US market, so much bigger. So we have size issues in global equities. The US market dominates most markets, and then actually China dominates. So what happens in those markets can unleash massive flows that have a real big impact. However, while you therefore remain connected with what happens in the other equity markets, if you have a decent story to tell as a stock market in terms of earnings growth and these sort of things, you can go on your own. Now, you have a fantastic chart here, right? India versus China versus emerging markets. And India, follows emerging markets sometimes, but sometimes also it just goes off, and that's been in particular here since the beginning of 2023. So I think India's story that we see now of good earnings growth, visible earnings growth, also earnings growth that is not so dependent on the macro factors, what happens with the central bank and what they do in India and interest rates. That sort of earnings growth allows you to stand out from the crowd, and that is good. But where, for example, global interest rates to go up, inflation in the US to go up, and the US market to correct significantly, if that were to happen, I'm not saying it will, but were that to happen, I don't think India can say, oh, we can expect the market to go up. No, all emerging markets will follow the US to a certain extent.
Herald, bring us up to speed with your thoughts and maybe HSBC thoughts on this. For the better part of the last quarter of the last calendar, and maybe even the month of January, the talk always was about when would interest rate cuts happen. Now that that conversation is getting pushed, I'm also hearing murmurs that while the cuts may happen, 1 or 2 or 3, what have you, but eventually we are looking at 2025 and looking at a scenario of higher inflation and higher rates coming in the US and other places. I'm just trying to understand, how do you think about a 3-year view? Do you think rates stay higher for longer? And is that net negative for US equities and thereby world equities? Or right now, you're focused on what will happen in immediate 12 months, which might mean rate cuts, i.e. maybe some optimism for equities?
Okay, so I think rates will have to come down at some point in time. The question is the timing of it. Why do rates have to come down? Just to clarify that maybe first, is that at these elevated interest rates, at some point in time, we will see the impact of that. The whole idea of raising interest rates to slow down economic activity. And that has happened much slower than we anticipated for a variety of reasons. The US consumer doesn't have as much debt and these sort of things. So, but it does impact overall economic activity. So we're going to see that slow. So I think we cannot expect interest rates to remain at these levels for a very, very long time. Let's say the next 12 to 18 months or so. Then the question is, okay, they will come down, but when and how fast? Well, we've been in the camp that it will probably come down a little bit slower and later than what people anticipated, at least at the beginning of this year. And we've seen a little bit of a recalibration in the market, right? In the beginning of the year, we saw bond yields come down, the market says, hey, they're going to cut interest rates, and then it was like, oh, maybe not. And the bond yields drifted higher a little bit again, and now they're coming off again. So I think somewhere in the middle of this year, we're going to see the first rate cuts, and then gradually second half of the year that will continue. And then into the next calendar year as well. So it will be a slow process, and this will be good for equities in general. And this is why we're positive on global equities in that sense. And it is in particular good for emerging markets, and in particular emerging markets where growth is good, such as India. But yeah, it will be a slow process, a bit slower than what the market is anticipating.
What about post-2024, Herald? Are we looking at higher rates than what's been the case for the last decade?
Yeah, I mean, over the last decade, the average interest rate has been very, very low.
Right.
The question is, were we maybe even below a sort of, there is some kind of magical, invisible average number. Technically, we call it our star. It doesn't matter too much, but at that number, we don't know what it is, but that's where interest rates going to hover around. Probably 2 or 3 years ago, when interest rates were really low, yeah, I remember in the US, bond yields were about 0.5% or so. That was probably below that level, but at the moment we're above it. So there's a wide gap. So somewhere in the middle is where we end up. So my suspicion is we're going to see a gradual decline towards that what we call R star, that average level again. But we're talking about 2.5, maybe 3%. At the moment we're over 4. So we're moving in that direction.
Herald, would love to probe this a bit. Normally, at times it is possible to predict with certain degree of certainty what could flows look like for a year. Calendar year 24 may not present that opportunity. One, the geopolitical stress that is on, and two, the number of elections that are happening across the world. So how do you view the possibility of inflows into emerging markets and India in particular in calendar year 24?
Yeah. If you look at the elections that we've had so far, and I'm focusing in particular on Taiwan and Indonesia. In Taiwan, we had an election, and when the results came out, it was like, okay, that's fine. And in Indonesia, we had a bit of a similar response. The thing is that the elections that take place in Asia, the market is anticipating that it will not lead to any significant or immediate change in policies that will impact the profits of the companies that are listed. And I think that's the underlying assumption that is made, for example, in India as well. So when it comes to flow, I think the elections, although they're very headline grabbing, are not really making a stir. What could create a stir when it comes to flow is what happens in Japan. Japan has got ultra low interest rates. There are signs that it looks like in May or March, or probably in April, they're going to change that, raise interest rates. The Japanese market has done well because of these low interest rates. So on the margin, that means that a tailwind is going to shift towards a headwind. That money might flow out of Japan. And then the question is, if that happens, where does it go to? And it could, of course, go to the US, but the US market is rallied already. It could go to Asia. It could stay in Asia. There's a good reason to believe that it would. It could go to China, but it also might, for example, move to India. So that's how we're looking at flows, not just at the elections, but also how people are positioned across the region.
Do you expect this to happen, Herald? I mean, these interest rate changes in Japan and thereby outflows, because that market, both property market and equity markets in Japan, have gone through the roof. So when does this change happen, potentially?
This could happen probably in around April. So what is going to happen is that the yen has been very weak because of the lower interest. Basically, they have a policy to keep certain interest rates at about zero. So as the US interest rates went up, the yen weakened, because why would you hold yen? The US dollar is more attractive, right? But a weaker yen is good for the exporters. And Japan, the stock market's got a lot of exporters, so they've done well on this. Now, this can go in reverse. If the Japanese raise interest rates and the Americans are talking about lowering it, that's what we earlier did, then suddenly the yen might not weaken, it might strengthen. That's actually what we think could happen in the second half of the year, or maybe after April already. And maybe that's a gradual process, but then, yeah, that support for the exporters there might fall away. And people might say, well, Japan has rallied already. It's been a great story. Should I hold on to this? Maybe not. If they do so and they take the money out, the question is, where do they go? You could, in the past, put it in the US at high interest rates, but those rates are coming down. You could put it in the US market, but then one has rallied already. So then you could say, why not emerging markets? Hey, within emerging markets, either China or India could welcome up. So that will be an interesting dynamic that could start to take place in about a month's time or so.
Wow, well, that's a great insight. Thanks for that, Herald. Two more Asia questions before we let you go. One of them is a potential impact of a Trump 2.0 on Asian markets, and multiple people are trying to forecast this, though it might be too early. Is it too early to think about it?
Somebody told me an interesting statistic that if the margin of error between the two parties in the US is very small, the independents will make it up. But a large group of the independents in the US have not made up their mind yet. So all the polls we see, that a particular person told me, we should take it with a grain of salt. That means that in markets, if that is the case, it is very difficult to make a forecast on who's going to win and what the policy implications are. We just don't know yet. What I do think in Asia, we need to assume that whoever wins in the US, that the US, and in particular China, in an antagonistic sort of relationship. That is nothing new. That has been taking place for the last 6-7 years now. So that will basically continue whoever wins. And that's a sort of assumption that I think I make, but a lot of people make. And then the question is, can equity markets perform under that? And actually, in the previous episode on the Biden, but also under President Trump, the Chinese stock markets actually performed pretty good. At least a parts of these periods. So we have to then look at what happens with the profits of these companies. So it's difficult to say anything about this at the moment. It's too early to make clear statements in my view. Whoever wins in the US is probably continue the sort of antagonistic relationships that the US and China have. That is nothing new. And then we come back to China and the rest of Asia. Can we still grow? And we can probably still continue to grow. Maybe slightly different. Certain sectors will differ. So it's going to be the sectors within the market that we have to look at, not the overall market so much.
Okay.
And India, and India is probably somewhat isolated from this anyway. So that's net a positive, I guess, for India again.
So just that follow-up there before I ask my last question, Herald, and that is this election season thing and the US election thing that we spoke about. And you rightly said India is isolated from that argument, but from an overall argument of policy stability, India must be amongst the few predictable ones pre-election as well, because it seems that there will be policy continuity happening there. Is that priced in already, you think? Or as you said, the election, the verdict that the markets gave to Taiwan or Indonesia was chalk and cheese. What could happen in India?
No, see, I'm not a political forecaster. For me, it's very difficult to forecast these sort of things in markets. But the underlying assumption
Herald,
that I think markets are making...
Herald, sorry, allow me. I'm not asking you to make a political forecast. What I mean is, if I'm making the political forecast for you, then let's assume there is political stability here in India and continuity of the government. Will the markets be surprised by it, or has it been baked in?
No, I think it's been baked in. That's actually what I wanted to say. It's been baked in. We as markets are not good at making political forecasts, but the assumption is it will probably continue in the policies will continue in India unless we get clear indications this is not the case for whatever reason. And also, I think if you look at the underlying drivers of growth in India for the corporates, they're not too overly sensitive on policies. For example, formal retail is gaining market share over informal retail. Now, you can raise interest rates, you can lower interest rates, you can have a weak rupee, you can have a strong rupee, gold price can go up and down, but that process probably continues. So it's these other structural growth stories that are unfolding in India that are not really macro sensitive. That is, I think, one of the reasons why India is so attractive. The risk to growth is not very high.
Herald, one thing around Asia, and I would love to understand from you, there's this whole chatter around what sectors in Asia are coming to the fore. This is my last question, really, and what themes and what sectors in Asia are coming to the fore. Because, and one of the principal ones that stands out is auto, presumably. I would love to understand from you, what themes out of Asia do you think stand ground to be the biggest performers or gainers or standout themes over the course of the next 2, 3, 5 years?
Yeah. So I think one theme is if global interest rates go down, certain sectors will benefit from this. Think about, for example, I'm talking about the whole region here, but for example, property and these sort of sectors benefit from lower rates, but banks do not necessarily benefit from that. So that's one thing I would look at. I think there are other themes. One of them I mentioned, a continuation of formal retail gaining market share over informal retail in large parts of Asia. A third theme I could think of is, for example, and India is a great example. I was in Tamil Nadu about 6 months ago for a holiday, and there you have highways. You drive for 25 kilometers on a highway, and then suddenly it stops. You're going to go off. Infrastructure is being built up, but it's not completed yet. So when that completes, you have all sorts of benefits that come from that. Transport costs will come down. It's easier to get from A to B. Tourism, travel between cities picks up, and all these sort of things. And all sorts of companies can benefit from that. And again, that's consumer companies, could be property companies, could be hotels, could be all of these sort of things. That's something I'm looking for as well as a theme in across the whole of the region. This is in India, but this is also in Thailand or Indonesia, for example, the case. And then there are a couple of other themes, but they're more related to North Asia, about smaller families, lower birth rates, technology changes, AI, and these sort of things.
Got it. Herald, India is doing a lot of things on tourism. Next time that you're coming to India, I'd love to fill you in on some other options as well, because we'd love to have you in Mumbai too. But thank you so much. Thank you so much for taking the time out and speaking to us today.
Thank you. Have a good day.
Yep, you too. And that's Herald van der Linde, believes that Indian markets have baked in some of the benefits or positives of the political and policy continuity already. But Indian markets may stay strong if indeed we show what is elusive for the rest of the world, which is earnings growth. That's all the time that we have on this edition of The Talking Point. Thanks so much for tuning in.